добрый день. Скажите, пожалуйста, меня слышно?
Да.
Прекрасно. Преподаватель сейчас подойдет, и семинар начнется.
Good afternoon, dear students. Can you hear me clearly? Please let me know. Should I do something with the sound?
Да, we can hear you.
Pardon?
Да, мы вас слышим хорошо.
Super. Thank you. Is it better? Okay, shall we start or let's wait another couple of minutes? What do you think? Okay, let's then start. Can you see the screen? Okay. Yes, thanks, Luke. Yeah, perfectly. Actually, it's much better if you will be speaking now, because here on this computer, it's not that easy to see the chat. Okay, fine. Looks like it works. Today we have seminar number 2, and we will touch on VC basics and some deal terms. This is the agenda. Actually, we will have today 5 tasks, different tasks, which all of them will be in the final exam. So if you have questions while we go through, please don't hesitate, stop me and ask questions so that everybody is clear and we're fine with that. So we will touch on high discount rates in venture industry. Just this is the basic thing which I'm sure we have to comprehend better. We will today also go again through the concept of pre and post money evaluation and capitalization table, and it will be the single stuff. We will talk about convertible notes, and we will have an interesting task on that today. And both, of course, liquidation preferences and participation rights, which already was mentioned during the last lecture, but today we will take again those tasks, change the numbers, and go much deeper into the problem. Okay, task number 1 is about high internal rates of return or target returns in venture industry. Just to remind yourself that usually when you consider corporate finance and calculate net present value, you assume that all cash flows are 100%, right? So you have 100% probability of having your particular cash flows. Of course, life is not that easy, and in venture industry, situation is more or less similar. You always have the risks of being unsuccessful. So actually, you don't have 100 probability of your cash flow. You have some probability of success, and of course, failure. And if we take the formula, we will see that our NPV is actually minus cash in, because this is 100%, right? This cash flow has 100% probability, but cash out cash flow doesn't have 100% probability. We should multiply it by probability of success, and given that it is in the future, we should also discount it back. So equivalently, we will have this particular formula, and actually to get your NPV, this will be the quite important part of the formula. If we go to IRRs, so let's consider that in terms of rates of return. We have invested particular amount of money, we have exited somewhere in the future, after let's say in T years, so whether it's 5 or 6 or 7 years. So if you would put that in internal rates of return, you will get the following formula, where IRR is the required rate of return on your investment today in particular project, which has its own probability of success. Of course, perceived probability, right? You always don't know exact probability, but you assume or you try to guess. And let's say RVC, which means return of venture capital fund. So this is your target return of your fund. Let's say you target 10 or 15% IRR on a whole fund basis. And what you do, you actually put particular projects into your portfolio, but when you negotiate about deal terms, valuation with founders and other investors, you take into account the probability of success. So actually, when you want to discount all the projections, you want to use your own IRR, which you will be using in all the negotiations. So let's just calculate this IRR. It is -1 plus 1 plus required rate of return on the whole fund basis, or your target rate of return, and you should divide it by this probability of success to the power equivalent 1 divided by t. As an example, again, I will remind it that this is the slide from the lecture. Suppose we are targeting the fund return 10% IRR. Not that high, but just for the sake of illustration. We have a project proposed to us which has a success probability of only 20%, which is still quite high, I would say. And we consider that there will be an exit opportunity in 5 years. Our required rate of return in this situation, when we will be discounting all potential and probable cash flows of the projects, management forecast, etc., all the things, or calculations we are making, more than 50%, almost always 52%. And this is the last slide from the lecture. So the higher the probability of success, the lower will be your required rate of return. Actually, it will be closer and closer to the required rate of return of your fund, right? And it's not linear. I see somebody is in the chat. I see. Thanks, Dacia. Okay. So again, the more mature the firm, the less the risks, the lower the discount rate, right? So we don't ask for high discount rate, which is equivalent of cheap valuation when you make an investment, if risks are low. Okay, now let's consider our first task for today. We have the venture fund, which actually targets gross IRR of 15% on a total portfolio. And this is something we are pitching in our materials to potential investors, to the market, and etc. Maybe that's number 5, that's 5th fund, and the 4 previous on average have had those IRR. So this is something we can pitch. And we have a situation that the partner of the fund was approached with particular early stage opportunity. And he assumes that the probability of success is only 10%. And given that it is early stage, it will take not 5, but maybe 6 years to get out of the investment. So let's try to calculate the required rate of return, or IRR, on this project proposal. Let's remind ourselves of the formula. So IRR equals -1 plus this part, 1 plus required rate of return of the fund divided by the probability of success to the power 1 divided by t. What we do, we substitute letters with numbers. We put 15% IRR on the fund base, on the whole fund basis, our target, to the numerator, and we take all the other numbers to the denominator. And this is now your time to calculate. It's easy. So please let me know what number have you got. Okay, perfect. Maxim, Danksha, Ivan, yes, Sergey, you're right. You're totally right. All of you right. Actually, this is almost 69% required rate of return. So for you just to get the flavor that early stage project with 1/10 probability of success should be discounted, I would say, with this particular rate of return. So this is basically the framework. So the project which has only 10% probability of success for sure has high risks, right? The higher the risks, the lower the valuations should be. How you get these low valuations? You apply the high discount rate, right? So that's just a form to compensate yourself for the risk you take. And in case the project will be successful, right, it most probably will provide you with quite high multiple, which maybe, even maybe, will return the whole fund for you in this case. This is the logical situation. So you try to put a chunk of your money from the fund into the projects with high risks, but big potential. And in case the risks have not realized, so success realized, you have a huge positive impact on your portfolio. Okay, it seems like there was a chat again. Yes. Okay, you're all right. Okay, now we go to the second task, which is the concept of pre and post money valuation, as well as capitalization table. Let's consider the situation which was already in the lecture, but we will take different numbers and go step by step. We have two founders who have organized the startup in equal shares, and right away they also put aside an option pool for future hirings. So remember, the option pool is something you will use to motivate new team members. You will provide them with this potential upside, right? You cannot pay them high salaries. What you will propose them to have is this option in success. And later, we have 3 rounds of financing, 2 angel rounds and 1 venture capital round. So let's say on the first round, first angel puts $250,000 with 1 million pre-money valuation. In the second round, second angel actually puts 650K with already higher pre-money valuation of 2.5 million. And then we have the first VC round with additional option pool. You will get the numbers right away. So our task in this situation is to find the final structure of the shareholders. Okay, let's start with the most simple part of that. Founder A and B issued 1 million shares to each of them and also put aside 500,000 in option pool, which they will be using for motivation. And nobody else is still on their own. So we have symbolical price per share of less than 1 cent, so actually 1/10 of a cent. There is no valuation, no money still invested, and shares outstanding in this case are known because we will see why they are known here. First round, angel round. First angel takes still common stocks in this case, not preferred. And first angel has agreed with founders that their business idea at this point in time worth 1 million. So this is pre-money valuation. First angel puts a $250,000 on top of that. So as far as you get, our post-money valuation will be 125 million. The number of shares outstanding here is the number of shares right before the round. So actually that's pre-round shares outstanding. And for us to get the price per share, what we have to do, we have to divide the pre-money valuation by the pre-round shares outstanding. So we will divide 1 million by 2.5 million shares, and we will get 40 cents per share. With this price per share, New Angel will get 625,000 shares, right? Is it clear, or I need to put some numbers on the deck behind me? Okay, I assume you find, but please don't hesitate to interrupt me. I'm here for you to get this idea clear. Okay, I see somebody. Better to put. Okay, Maxim, agree. As far as you get, you don't see the video, right? I have to stop the demonstration. Is it correct? No, we see you. Oh, perfect. Great. Then it will be easier. I hope you still can hear me. Okay, let's put the numbers. Yes, sure. Great. Okay, just a second, please. Actually, what I will do, I will turn on the light for you to better see the deck. I hope it's better now. So let's consider the situation. What we have now is we have this option pool. And founder A and B, right? No money still invested here. Now we have the new investor coming. He puts 2,050K into the business, right? And the number of shares before round happens here is already, okay, I will put that number of shares, 2.5 million. Right, this is investments, right? Remember, the pre-money valuation is 1 million, which means that post-money valuation is 125 million, right? But for us to get the price per share, which is PPS, price per share, we will be using the number of shares before the round and the valuation of business before the money we're using around. So what we have? We have, I would say 1, 2, we take 1 and divide it by 2. We have 1 million valuation, which should be attributed to 2.5 million shares. 2.5 million shares. And you will get 40 cents per share. So far, so good? Is it better?
Sorry, can I ask a question?
Of course it is.
How did you calculate, where did you find 125 million post-valuation?
Of course. 125 million, that's pre-money plus investment. Remember, our formula is cost equals pre plus one.
Okay, thank you.
Okay.
Sorry, could you remind please what is pre-money options?
What is pre-money options?
Mhm.
Yeah, that's actually the stocks which we put aside for the motivation of future members of our team. The logic is the following. Usually startups have negative cash flows, right? Have negative cash flows, and they cannot provide you with high salaries like big substantial business corporations. But they can provide you this upside in terms of stock, right? So in case the business will be successful, you as an employee, one of the important employees of the business, you will get not only some salary, but also you will participate in the success of the business as a stockholder. But you will be provided with these shares finally through either directly with vesting or with options. So options will allow you as an employee to buy the stocks at particular strike price, which might be below the market value. So you will get your compensation. So part of your compensation is this upside, but it works only in case of success. So you as an employee will be very much aligned with both founders and investors, and you will be interested in the success of this enterprise, of this startup.
Okay, thank you.
Yeah, sure.
Could you please say what is the percentage size of this pie? Option pool.
Yeah, it is 16 now. So the question, how do we get this 16 or what?
No, I mean in real life, what is the percentage size of option pool? For example, founder A has 50%, founder B 40, and option pool 10 or.
Yeah, okay, Igor, I think I got the question. I will try to answer. So as far as you remember, in one of my lectures, I have provided this slide, the market practice. So option pool on average is about 15%, so 1/5, right? If we talk about the shares of founders and particular investors, it's always the result of the negotiations and sequencing of funding. So there is no actually market pricing. But as far as you remember, on each stage of on each next investment, on each next financing round, all previous investors are being diluted. Only in this situation, the new investor can get some share in the company, right? So, but it doesn't. It happens not because somebody buys previous shares, but usually because new shares are being issued to new investors. Sometimes you have combinations. So there are cash-in deals, there are combined deals, there are cash-out deals. Cash-out is when no new shares are issued, only particular shareholders sell their shares to new shareholders. But it's just something we're not considering here because it is just another variation of that. So in base case scenario, you always got your new investors who usually got new shares and get particular part in the capital stack of the company. As a result, previous investors are being diluted, but in terms of percentage, right? They hold the same number of shares, but just because the total number of shares is constantly increasing with each new money coming in. So the percentage share is decreasing, but the valuation of the business is increasing in best case scenario. So as remember, we always have this game of multiplying decreasing share in the business by increasing valuation of the business.
Yeah, I got it. Thanks.
Yeah, sure, of course. Okay, so again, we have this, we have new investments, this is our basic formula, and this is the price per share. Now let's go to the next round, when second angel investor is coming in. As far as you might see, in this case, let's say the stock type is preferred, right? A moment, sorry. So we got what we got here. Actually, we take the first angel round to the left, and we have the new thing appearing to the right. So in the left part of the table, we have the same numbers as in the previous round, and this the blue one is second angel round. In this case, the angel puts 650K into the business. Second angel has agreed with founders and previous angel that the valuation of the business idea at this point in time is already 2.5 million. The reasons might be different, but the idea is the following. Usually you have the next round, then the milestones are hit, or I don't know, some traction is in the place. In basic terms, risks of failure has decreased, which means that valuation of the idea has increased, right? So what we have, the pre-money is 250. So what we should change some numbers here. So we will have already 650. Our pre-money valuation in this case is already not 1, but 2.5, right? If we put them together, we will have post-money valuation 3.15 million. This is post-money. We do the same exercise. What we will got here is 2.5, but the number of shares we have to use is the number of shares after the previous round, which is, I will try to comment here, which is here. You see, this is what we have to use. So we will be using 3.25. I'm sorry, 3,125,000 shares, and we will get 80 cents per share. So increase 2 times, right? From round to round, double X, 2X. Clear, or you still need some numbers on the deck?
Excuse me, and this share price is the price for the new investor, right? The last one.
Yeah, sure. So what we need to get, we need to understand at what price new shares should be issued. And actually, if you look at the number of preferred shares issued to new second angel, it's 800 to 1,500, right? How we get this number? Let's put this. Can you hear on this side?
Yes.
Okay. We put 650,000 US dollars. So the number of shares which we get is our investment divided by the price per share, right? It will give you exact the number we have in the table. So this is the number of new shares, and as far as you can see at the bottom of the table, the total number of shares will again increase from 3,125,000 to roughly 4 million shares, just slightly below that number. The new angel will get slightly above 20% of the capital stack, and all other investors, including pre-money option pool, will be diluted. So far, so good? Okay. Let's look at the next stage when the venture capital fund is coming. So on this stage,
Sorry, excuse me. Can I clarify, please? I cannot distinguish. You divided 65,000 by what amount? I cannot see.
okay, sure, of course. Just a moment, please.
And how did we get 80 cents for second PPS?
This is the number. This is the money we invest into the business as the second engine, right? The price per share in the round is 80 cents. So we divide the number of money, okay, the capital we invest in by the price per share, and that's why we got this number of shares. Actually,
Okay, thank you.
and what was your question still about how we got the price per share? I can do it again, no problem.
Yes, I didn't get it.
Okay, of course. Okay. So we will go back to the previous slide, okay? So I will try to use Zoom things. So first of all, okay, let me try to do this. Step one, total number of shares on the previous round is this number, right? So we have 3,125,000 shares in total issued. Oops, I'm sorry. Some technical things. Then we have agreed that the pre-money valuation is 2.5 million. So this is how we agreed on that. The valuation issue as it is will be the part of our next lecture. But as of now, so this is the number new investors and old investors has agreed on. So the business worth $2.5 million pre-money, which means the business itself without new money. And we put new money into the business, the next amount, which is 650K. It means that right after the investment, our post-money valuation, including this money as a part of the business, right, will be 3,150K. So if this is still not very much clear, try to compare that with the concept of net debt. When you value the business in corporate finance, you have this net debt, right? If the debt is zero and you have cash, so you know that net debt is negative, right? So enterprise value plus net debt, which is negative, will give you lower equity value, right? So this is more or less the same concept, right? You have this lower equity value before you have cash, then you put cash in that and you have enterprise value, which actually tells you that the whole business is the business itself plus cash on the balance sheet. So this is more or less the same. Right in the next moment, after the investment, you have the value of the business plus cash. So post-money valuation is actually the business plus cash. In this case, it's 3.15 million. The number of shares outstanding is the same number as here. So to get this number, we take the pre-money valuation and divide it by the shares outstanding before the round. This is how it should work.
Okay, thank you so much.
Yeah, and then given that we now know the price of the share, I will try to use another color. So this is the price per share, which we just have found. And new money is 650K. It means that you will get actually this number of shares, because if you multiply this number by this price per share, you will get exactly this number of cash in the business. Okay?
Yes, that's clear. Thank you.
Okay. Of course. Okay, I'm clearing that. I'm taking this out. So same logic will be applied on every next step. Now let's consider the situation when new venture investor is coming, and I will stress that again, it will be interesting. We have new option pool stocks, which actually goes before this venture investors are coming into the business. So the logic is the following: investors has agreed to provide you with capital of your business, but they say, look, your option pool is too low already. The market practice is something like 15. Given that we will most probably will get the next couple of rounds after this round, you should increase the option pool to 20%. So first of all, you issue new stocks into the option pool, so you actually authorize them. And then we put our money and get 25% of the business, right? And what is happening? They agreed that the pre-money valuation already is 6 million. So it's almost 2x, right? Always compare post-money on previous round and pre-money in this round. The venture fund is putting 2 million. So the post-money valuation, as far as you get, is $8 million US. Now, the interesting part is how we get this number. As far as you remember, it always was the number used on the previous round. But in this case, these numbers are not exactly the same. What we have to add is this newly issued stocks into the business. So for venture capital fund investments, the shares outstanding actually is higher because he has agreed to invest only after additional stock for motivation of future team will appear. It's just as one of the examples. Don't consider that as always the case, but slightly to make it more complicated, we take this into consideration. And all the mathematics is the same as in previous round. So we take this pre-money valuation, we divide it by this updated number of shares to get this price per share. And after that, we take the money we invested, we take this price per share, and from these two numbers, we get this number of new shares in the round. Right? And
can I ask you a question? 750, this number of shares is addition to 500 or just the transformation of 500 we passed to 150? Or it's just additionally 750?
Yeah, of course, that's additional, and I will show you why. We have 500 here, 750 here, and 1,025,500 here. Sorry.
Okay, thank you.
Yeah, so actually the total post-round shares, so in this round, we will issue additional stocks into the option pool and additional stocks to the new investor. We'll put that together to the numbers we already had, and we will increase our total number of shares from slightly below 4 million shares to 6.25 million shares. As far as you remember, 100% it's always the total number of shares. So you proportionately get these numbers, right? You just divide 1 million by 625 million, 1 million by 625. So the final capital structure is actually this. We have this fully diluted, which actually assumes that all the stocks in the option pool will be finally vested and issued, and just they will be available to somebody who are they assumed to be for, right? It's not always the case, but fully diluted share gives us the floor of our capital stack, right? In case not all stocks from option pool are issued in favor of particular team members for motivation, it just means that the percentage ownership shares will just proportionately increase. Okay, if this clear, then we have the next task, and let me know if we shall proceed. Okay, interrupt me when you need it. Next task is the liquidation preference task. As far as you remember, one of the concepts in venture investments is last money in, first money out, which means that actually later investors have some preference before earlier investors. Consider this situation. New company has raised actually 2 rounds of financing, 3 million in Series A round and 10 million in Series B round. In both cases, I show you the post-money valuation for the sake of easiness of share calculation. So we have put 3 million on Series A, and the post-money valuation is 20. So actually pre-money was 17. In Series B round, investors have put $10 million and the post-money valuation was 50, which means that, of course, pre-money was 40, right? In both rounds, the liquidation preference multiple was 1, which is okay. This is normal, nothing special. But the problem was after that. So the company was acquired, but for only 40 million. So actually less than the last post-money valuation. And what we need to do now is to illustrate how this liquidation preference actually impacts investors. And we will consider high liquidation preference multiples, seniority of B investor before Series A investor. Okay, actually we have found some small mistake with your colleagues before. This is not something we will consider, but still, let's look at the most part of the task. First of all, we have a couple of caveats here. And the first one is this state. So remember, Series A investors have invested 3 million, Series B investor have invested 10 million. When you invest 10 million with post-money valuation 50, it's easy to get 20%, right? Because I will use the deck again. If you invested 10 million into the company with post-money valuation of 50, it means that pre-money was 40, right? This is post-money valuation because this is P. So you get 10 to divide by 15, which gives you 20%. And that's easy, right? So for Series B, that's easy. But let's remember that we invested 3 million with post-money valuation of 20, right? This is what Series B. On Series A, what we have 3 to divide by 17 plus 3. Remember, right? This is investment, pre-money together. This is post-money. So 3 to divide by 20. What is percentage? Can you tell me, please? Is it 12.5 or it's higher? You better sound because when I'm at the deck.
It's
yeah,
15%.
Yeah, sure. That's 15%. How do we get 12.5? Is it mistake or it's correct? It's not mistake. This is correct number because after that you have another round of investments. Remember the previous task? With each round of investment, previous investors are being diluted. In this case, this will become 12.5%. I hope this is clear.
Could you please explain how can we get this number? I mean 12.5%. It's not clear how did we get it.
Okay. Do you see this picture?
Not really.
Not exactly, right? Okay. I will try to do it here. So remember what we had, we actually had 15%, and here we had founders A and B, right? Then another investor has appeared, right? If you consider that this is, I would say, I don't know, 100 stocks altogether, so let's say the number of shares was 100, right? It means that here was 15 shares, right? Just to get the flavor. Here, after Series B investor has put money into the business, he has 20% in the capital stack, right? What is the total amount of shares here? And what is the number of shares he got? Can you just estimate that roughly, or we need, we better do it together?
All right. If I understand correct, we just should multiply 3 by 24. 24 we got from multiplying 20% on 1.2, yes?
Yeah, 1.2. So you can do it in many different ways. I'm sorry. You can do it in many different ways, but you can take your calculation. So the idea is the following: that was 100. It was diluted. So the basic thing is just to divide 15% by 1.20%, right? Which will be like that. So there was a dilution, right, by this additional story, which means all these investors, including Series A investors, should be proportionally diluted. So the easiest way is just to divide it by this number. But you can do it the other way, right? If I put X here so that I get 20%, right? And here was 100. It means that X divided by 100 plus X is 20%, right? If you do this calculation, you will get the theoretical number of shares, and if you will, again, do the same calculation, you will divide 15 by this number of shares. So here it should be the number, so you will get this number. You should get this number.
Yeah, it's clear.
Yeah, so yeah, I propose to move. It's just a technical thing, you will play with that, but the idea is the following. We have 2 rounds, and the Series A investor, the percentage share should take into account the round after that.
It works like stock dividends, right? I mean, it's dilution effect.
It's not stock dividend, it's just the appearance of new shares, which means that you just get the higher number of total shares, and with the same number of shares which you hold, you just get the lower percentage share in the total capital stack, which is, it's just a dilution.
Thanks.
Yeah, sure. Okay, so now let's look at that. Just a moment. It's slightly different. So we have liquidation preference of 1, which means that both investors have to get out, to put out of the business of this investment at least then their investment cost, right? Given that the total value of the business was only 40, we will have this dilemma, right? Whether to convert or not convert. Remember, preferred shares allow you to be higher in the capital stack than common shareholders to get your money out first. But in case the business is successful, you will convert to common stockholders, I'm sorry, to common shares to participate in this upside. So if the share is usual preferred share without participation, you should decide sometime to whether to convert or not, or you should wait until IPO when all preferred stocks will be converted automatically. So in this case, what we have, let's consider this situation. I will be changing colors. The first one, this column. Let's suppose everybody is in the same common share class. So both Series A, Series B investors have converted their shares. We should split the 40 million proportionately. So the common stockholders will get 27, Series B 8, Series A 5. Let's consider now the situation when nobody will convert. It means that Series A and Series B investor will get what they invested. This is, of course, not something they wanted, right? But let's just consider. The founders will get 27. In the middle, we have the situation when Series B will not convert, but Series A will convert. So according to the game theory here, we have the situation that Series B investor will not convert, and it's easily understandable because Series B investors have put money into the business which post-money valuation was higher than the deal valuation, right? So actually, when there was an exit, the valuation was lower than in the last round, which means that actually Series B, he didn't get his participation, his upside, right? So he will for sure say, no, I want my money back. It's not success. So he will not be converting because he will get otherwise lower number of money. In this case, we should actually, effectively what we should do when we calculate, we should actually, after that, we should assume that there is no Series B investor. And we should split the remaining 30 million proportionately to Series B, to Series A and to common stockholders, proportionately. And we will get this number, 4, 68 and 25, 31. So in this situation, the liquidation preference will help Series B investor to avoid losses, right? And the Series A investor will still make some money. They have invested 3, they will get out 4.69. It's for them, there is a sense to convert in this situation, right? At the point when the deal is being done. Actually, they will get part of the dollars from common stockholders in this case. Let's look now at the situation when the preference multiple is high. So as far as we get, we have 1.5 here already. So it means every dollar invested should be multiplied by 1.5. Right? So upon the deal or liquidation, investors in Series A and B rounds shall get 1.5x on their cost. Do the same math, we see that again. In this case, there is no sense for Series B to convert, right? It is not something he wants. So this is not something we will get. Right? In the situation for Series A, given that Series B will take 15, not 10, right? So we will assume that after Series B investor got the 15 million, we have only 25 left to split again between common stockholders and Series A stockholders. And here Series A should decide whether to convert or not convert. And shall he convert, he or she or they will get less than 4 million back. But if they stay unconverted and will use their preference, they will get 4.5. So in this case, Series A will not convert as well. So in the end, actually, this will happen, right? And Series B will get 15, Series A will get 4.5, and common stockholders will get only 20.5, lower than in the previous situation, right? So as far as you might see, liquidation preference here actually help investors to get some return in the situation of not that successful exit. Not bad, but not that successful. Still, it's something in this left-hand part of it, right? And common stockholders will get lower numbers. So the people who pay in this situation is the common stockholders. They still got 20 million out of the business when they sell that, but this number is lower than it was before, right? Just for you to remember. They got 25.31 when the preference multiples was one, and they got only 20.5 when multiple is 1.5. Let's consider the situation when the multiple is 3 now, right? Here and here. We have the situation then, it's very unusual, but that was something as a market practice after the dot-com bubble. So LICPREF of 2-3x was something in the market. Money was very expensive for startups. It's the vice versa situation currently. But still, in this case, the Series A and Series B investors, actually, they got almost all the proceeds from the deal. Of course, the only way the deal will be done and capital will be split is on the left side. So neither Series E nor Series B investors will convert. They will get 3x on their on the expenses. I'm sorry, not expenses, on their cost. And the remaining 1 million will go to common stockholders. Not very exciting, right? Something to spend on coffee during your life, somewhere in California. But still, just for you to get the difference of how important LICPREF multiple might be when the exit is not that successful. It's not bad exit, right? It's not awful, right? But for common stockholders, the higher the LICPREF, the worse for them. So they bear the more and more risks in each unit of LICPREF multiple. Okay, this was something that was mistaken task, but idea is the following: in case Series A and Series B investors are not, let's say, pari passu, so let's suppose Series B investor has higher priority. He will get his money first. In this case, that's not a big deal, but let's suppose the LICPREF multiple will be, I don't know, 4. It means that Series B investor will get 40. And only after that, Series A investor will get something. But given the deal is 40, all the money will go to Series B investor. Okay, so far so good, guys.
Sorry,
Huh?
can you explain please one more time? How did you calculate 1.56 in Series A, 8.44 in common, and the third column? Sorry, I don't understand.
So
Yes.
I will just mark it, and you please tell me that I'm correct. So you want to get this number
Yes,
and this number.
and the third column, all column, yes.
These numbers are just proportions of these shares. So you split this 40 million according to this percentage ownership.
Okay, thank you. Mhm.
Yeah, so you see 20% of 40 million is 1/5, it's 8, right? So 8 multiplied by 5 is 40. So similar other numbers.
Yes, it's
The-
right. Mhm.
Yeah, with 156, it's a little bit trickier I will try to explain you now. Remember, when Series B investor has not converted, let's suppose a situation that Series B investor has not converted and Series A investor has converted. So we have subtract this because this 30 million goes first out. So what we have now, we have 10 left, and we have 2 investors left, this one and this one. They have proportionate share, right? So it's not 100% now, but still they have some proportion among themselves, right? If you divide 12.5, sorry, if you divide, I will do it myself now, just for the sake of easiness. So actually, if you divide, you see that the common stockholders is 5.4x larger, has 5.4x larger number of shares than Series B investors, right? If this is 1x, so it's 1x, then it means that the common stockholders is 5.4x, right? So actually what you have 6.4 to be split by, like 10 to be split in this 6.4. And if you divide 10 by 6.4, you will get exactly this number. So proportionate increase number will give you this. It's a little bit complicated, but the idea is the following: you take out the money, which actually uses liquidation preference, but you also have to take out the ownership of this investor. You have the remaining investor left, which are common stockholders, and you have to split the remaining capital proportionally.
Yeah, but what is 10 and 6.4? Like 1 and 5.4 understood, but it's just the sum of 1 and 0.5.
Okay, so it's just the sum of 1 and 5.6. I just calculated the proportion among these two numbers.
Mm-hmm.
Yeah,
And
so
10 is, and 10, why do you take 10?
10 is the difference between, yeah, sure, no problem. Thank you for questions. Actually, you are making this much clearer for everybody else. So actually, we start with 40, right? But we know that investor B has taken out 30 already.
Ah, okay. Mm-hmm.
We have only 10 left. So first of all, Series B investor told us, I'm using my liquidation preference. I'm taking out 30. Okay. In case Series A decide to convert for some reason, I don't know. Of course, according to game theory, this is the stupid thing he can do. But let's suppose he does that. He will have just a small fraction of the total ownership in the remaining 10 million. So he will get only 1.56. That's why he will not do that. He will not do that. He will say, no. I will not convert. I will use my liquidation preference multiple. And I will get 8 back. I will make 3x on my investment, then that's fine. I hope I answer.
Yes, and how did they get 8.44?
8.44. What is 8.44? Ah, this one.
Uh-huh.
But okay. I will try to do it here. Okay. Maybe it will be much easier. So what do we have? Sorry. It will take a little bit longer with other tasks, but still. I'm glad you are trying to make it as possible, as clear as possible. Okay, we have the deal of 40, right? 30 goes to Series B. So we have only 10 left for A and common. Agree?
Yes.
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 In the capital structure, we have 67.5 common stockholders, right? Common. We have 12.5A, and we had, not anymore, but still we had Series B, right? That was the total pie. Given that Series B has taken out his capital money already, this is not the case already. Agree?
Yes.
So what you will have, the proportionate shares, so actually without this B investor, we goes back, we have to divide it by 0.8. Something like that. So actually what we have these two investors left, and they have together to split somehow $10 million US. So what we have, we will have 12.5 divided by 12.5 plus 67.5 multiplied by 10. And this will go to Series A investor, right?
Okay, yes. Mhm.
This should give you this exact number, 156. So we have two parts, and we just split them proportionally. Mathematically, you will get this formula.
Yeah, okay, I got it. Thank you so much.
Of course. Okay, but given that he will not do that, right? Given this high multiple he has. Okay.
Anton, one short question, please.
Yeah,
From
sure.
the beginning of these cases, I didn't get why we take 40. Why exit value is 40? According to conditions of this case, as I remember, we had value 40 or 50 after Series B funding.
Yeah, this is, yeah, that's actually the task. So the company was acquired after the round. So there was round A, there was round B. Round B was 40 per million plus 10 in the business, which gives you 50 million post money, right? And let's say in some time after that, the total deal, the company was acquired for only 40, not 50, not 60, not 100, but lower valuation. That's why we have this problem, right? So that's why the investor has to decide whether to convert or not convert. And for Series B investor, that's the simple task. The valuation of the business has decreased since the time of his investment, which means he should use this liquidation preference. This is what you get as an investor, as the last investor in the venture business, in case of, I don't know, unsuccessful situation. That's why you need this preferred stock. This is the feature which gives you this protection, this downside protection. Actually, what Series B investor got, he got his money back in case of 1x, right? In case the number is higher, he even secures some return for him. In case there is enough money, because you can just have the situation when the company goes bankrupt, right? You will get zero still, despite the number, the higher multiple. But in case you have some exit, a situation like that, you get your money back, and sometimes with high multiples, you even still have return. Who suffers? Those who before you in the capital structure, right? I'm sorry, under you. Those who invested before or even just started the business. So the founders and previous investors. In this case, Series A and Series B investors are considered to be on the same page, but it's not that common. So in more realistic situations, Series B investors will be higher in terms of priority before Series A investors.
Thanks.
Yeah, of course. Okay, let's just move on because that was not that expected. So convertible note. But maybe no, now let's go to task. I'm sorry, let's go to task 2.5 first. Then we'll go back to this convertible note. So the participation right. Let's consider the similar situation as before, but we have not simple preferred stock, but preferred stock which has this participation feature. Participation feature, as far as you remember, and as far as you will read in the book, I hope you have started that, you have only 4 chapters to read. It's not that much. Please do it. It really will help you in many, many aspects. Participation feature allows you not only to get your cost or double X on your cost if the multiple click path is true, but also to participate proportionate according to your share in the remaining value of the business upon the exit. You will see now. So let's suppose the situation that the company has raised 5 million in Series A at 25. Again, post money, I will show it for the sake of easiness of calculation of the percentage shares. The next round was Series B, 15, for 75 post money. In each case, as far as you get, in A, it was 20 pre-money, so 25 post money. In Series B, it was 60 pre-money together with 15. It gives you 75 post money, right? But in each step, you see that 1/5, so 20 per each investor was taking 20% at his series investment. In both rounds, we had liquidation preference of 2x. And the financing was done with participating convertible preferred stock, or PCPS, with, interestingly enough, the cap on that. So 5x is actually the cap when your participation stops. It actually allows you as a founder to secure the case and the situation, the value for you in case when you have huge success. So actually you are not providing investors with, I don't know, free ride on, I don't know, huge success, very rare one. Because investors will already get 5x, right? And Series A and B investors have the same priority. Situation is similar to the previous tasks. The company was acquired, but for higher number, for the high valuation in comparison with the last round, right? In previous situation, the deal value was lower. In this case, it's higher. Let's look at what it gives us. Again, as far as you remember, same trick is here, right? 20% on each stage, but Series A investor will be additionally diluted with Series B, right? So it will become lower. It will become 16.7. So the common stockholders will get 63.3. Amount of investments at 5 and 15, given this is the liquidation preference, and this is the participation cap. This is the exit value of the deal of the company. First of all, given the liquidation preference, in the Series B investor and Series A investor will get double on their money. So 5 will become 10, 15 will become 30. What you have left is 110. So it's easy, right? 150 minus 40 will give you 110. So this is the remaining equity value, which we should somehow split among Series A, Series B, and common stockholders still. So 10 and 30 already is taken off the table. Now we have the remaining value. Now let's split that. Each investor is participating with this percentage ownership in this number. But in this situation, we have the cap, which has worked. How we get that? I will try to show you now. First of all, we have this 10, right? Together with this 15, this number gives us 25, right? This is exactly 5x on the initial investment. So here the participation stops for Series A investor. So he is not participating in the upside after that. Series B investor is participating proportionately. As far as you get 20% of 1.10 is 22. As far as you get 30 plus 22, I don't know how to do that. It's not maybe the good color. Okay, we'll use this one. This and this will give you 52. right? 52 is less than 5 multiplied by 15. Where I take 15 from? From initial investment, right? So it should have been 70. So it means that actually Series B investor is participating all the way up, right? He got less than 5x on his investment. Series A investor has got 5x and he stops his participation. And we have this number remaining for common stockholders. So in a nutshell, we will have this split of equity value among the stockholders. The question in the task was the Series B, proceed to Series B investor. And this is 52, I'm sorry. Right? Series A got 25, which is 5x. Series B got 52, 52, which is less than 5x, but still nice return. And common stockholders will get the remaining part, which is 73. I maybe will clear this just to answer the questions if you have. So in a nutshell, similar situation, 2 rounds of investment, the exit is successful, right? But the structure of the deals was so that it was actually very investor friendly, quite investor friendly, I would say. So investors not only got double X on the initial investment, but they could also participate in the upside in case the exit is quite successful. If this is very successful exit, then the common stockholders take this following upside from particular valuation of the exit, right? So should we put here some other numbers, we will get more or less the same numbers for Series A and B, but higher numbers for common stockholders. I would say that if you look at this sensitivity table, we actually was here. We were using this number and this number. So what we got here, right? So this number was increasing with participation cap increasing, but then it stops, right? But the higher the value exit, the bigger part of this we have a Series B investment. Still has some caps, right? Something like that. Okay. Do you have any questions with this task?
Yeah, I have one question. So as we have previously mentioned, we have executed a liquidation preference in the amount of 40 million and 110 left. So actually the question from my side is, why should we further divide this 110 million between Series A and Series B after we have already executed liquidation preference?
Yeah, thank you for the question. The answer is simple, because this is another type of shares. This is the type of shares which is more favorable in terms for investors. Less favorable for founders, more favorable for investors. So actually, it's more or less the same, but investors they have secured some capital back. In this case, double X, but it can be 1X. So you got your cost back, but then you participate in the upside.
So in this case, we can see that in this situation, it was like kind of a bonus for investor for this event, the event of
yes. Not only, but the idea was they have structured and agreed the deal so that in most cases, they have secured some nice returns. Not very, I would not say very high, but this is the type of the deal when investors most probably will get positive returns on their investment.
Okay, I see. So first of all, they get a kind of a bonus, and then they participate in further division of.
Yeah. It's just for you to remember. You might have the step number 1, preferred stock in comparison with common stock have some features which gives you preference, right? So in the capital stack, you are higher than the common stockholders. Then when you structure the deal, you can play with this liquidation preference multiple. So the idea is the following: you either get your cost back or some high number. In this case, it's double X. In addition to that, the stock itself, this participating preferred stock, it has this first word participating. It has a feature of participation in the capital stock after you put some capital off the table. So you have secured some preferred multiple, you take it out of the table. If you still have some capital left, you still participate in that proportion, but not indefinitely. So it gives you a nice combination of, I don't know, some secured return and some potential upside.
Okay, thank you.
Yeah, sure. Okay, now, given that that was the last task, we have to go back to the quite interesting one. It will help you to solve one of the tasks you have in your Google Classroom. I hope everybody is in the Google Classroom. I have only 2 people still in gray. Please just read the books, read the papers, and start doing exercises and tasks. So we have the following situation. We are an investor in the company, but through convertible note. Remember, that was something we have discussed already in the lecture. After 1 year of our investment, in 1 year, the company finally raises Series A financing round, and this round triggers the conversion of our notes into the share, into the same series, of course, 8 shares. So what basically happens, we are from debt providers become equity investors. But there are some tweaks here around. Given that we have provided money before this particular Series A investor, we should have some compensation for that, right? And first of all, without this conversion, shouldn't be just normal situation. The pre-money valuation was 12. Investor in Series A round actually put in cash 4 million, which gives you post-money valuation of 16. But to this moment, our principal of our convertible debt, convertible note, plus any accrued interest on that equals 1 million. So let's suppose we have provided 900K almost a year ago at 10%, at 11%, and now it's roughly 1 million. This is what company actually view us. The discount rate for conversion, remember the convertible note has 2 important things. It's discount rate and cap on valuation. In this task, there is no cap, so there is only discount. The discount is 25%. And actually, the number of shares before this conversion and new investment, so pre-round number of shares, exactly 1 million, just for the ease of calculation. We are using here percentage ownership method when we make all calculations. You have to read about that. I have provided the paper from Cooley, but just to give you some idea, it's when they actually fix the post-money valuation and make all the calculations from that. We will do this right now. We will have to find the number of shares which we receive as a convertible note holders. And our percentage ownership in the company after this round. So when the round happens, we convert our notes into the stocks. We have some stocks, so there will be some percentage ownership. I put in italics some text here because it is taken from exam. So you will be having that during your exam. So when you will be putting your answers into the system, bear in mind this stuff. So you will have to round that to decimal points. We have to find price per share in this round and the pre-money valuation. So here, pre-money valuation is not that easy actually. So actually putting only one small tweak, convertible note into the exercise, we quite complicates the whole situation. You will see now. Yeah, just round all the numbers. So let's start with simple things. Series A investor are putting 4 million And the post-money valuation, remember, it's fixed. We assume it's to be fixed, is 16. Easily enough, we have 25% ownership of Series A investors. I think that's clear, it's easy, right? It's one of the things we've done already many times. The next theme is quite interesting. At this point in time, we consider as if note holder is investing the money the company is due to him together with all the interest accrued, which is 1 million. But we should take into account the discount. In this case, 25% is just a consequence. So here the discount rate was also mentioned to be 25%. So effectively, to compensate the note holder for the risks he has borne actually for the year before the Series A round has happened, we should accrue to him like additional capital, as if he is investing today 1.3 million or something. So effective investment amount, both cash plus non-cash, which is conversion, right, will be actually $5.3 million, which gives you the effective pre-money valuation slightly different, not 12, but 10.67 in this situation. And your price per share will be calculated based on that number. You divide it by the number of shares before this round happens. Remember, that was exactly 1 million. So you take 10,666 divided by 1 million, rounded by 2 decimal numbers, you've got $10.67 per share. That's the price per share in this round. But effective price per share for us as a note holder should be cheaper, right? Because we should again use this discount, 25%. So we effectively will be buying at $8 per share. Effective founders' ownership will actually decrease, right? They will be diluted, which is normal, right? Because if somebody is becoming shareholders instead of being debt holders, they should take part of the company. Given that the Series A investor has invested cash and took 25%, it's naturally that founders should give away part of the share in the business to note holders. So we divide 10.67 million by 16, which is fixed post-money valuation, and we get, again, 2/3 is the share of founders. The effective ownership of note holders, of former note holders who are becoming equity holders on this page, is just dividing 1.33 million by the, again, fixed post-money valuation, which gives you 8.33. And as far as you remember, the initial number of shares was 1 million. The equity ownership for this number of shares is now only 66.67%. If you divide it one by another, you get that the total number of shares after this deal should be 1.5 million. And now we'll see how they should be split. Remember, founders are left with the same shares, right? They were only founders and note holders. All the shares were founder shares. The number of shares do not change, doesn't change. Series A investor is getting 25%. So his number of shares will be 375,000. And shares to note holders will be 125,000, which will give them their proportionate share, 8.33. As far as you see, altogether, the percentage ownership is 100%, and the number of shares is 1.5 million shares. I think you will have some questions. For sure, you will have to look at that yourself, but I'm ready to answer some of them. We still have some time.
Could you please upload this presentation in nearest future, maybe today or tomorrow?
Yeah, of course, of course. I'm trying to do that now as fast as I can. Not from here, but from my flat. Yeah, I will do that for sure. But bear in mind, please, that this is just only one of the tasks. So with one of the tasks, you have actually the task on convertible notes. So I provided in Google Classroom some white paper, right, with some tasks on the convertible notes. And this is actually one of the approaches which you can use. You will have, as far as I remember, 3 approaches. One of them is fixing this post-money valuation. There are 2 other approaches, and you please play with that. It is the additional marks to the total mark for you. So that's let's assume that's a bonus task, but it is first of all interesting bonus task, hard bonus task, and it will give you additional mark. And for sure, you will be one of the people in the market who at least more or less understand how it works.
And on Saturday, are we going to have these types of questions on the test, or it will be the question from the previous seminar?
Maxim, pardon, I didn't get all the words you talked. Could you please repeat that again?
I said on the next lesson on Saturday, are we going to have the same types of questions already, or it will be questions from our previous seminar?
You will not have this particular task because it's quite difficult. I know that, and that's why it is a bonus as a task. So no, not here. I think there should be one task on exam with that, something like that. But the exam will be not easy. It will be structured so that even with open book, it will be difficult to do it, right? So you will do the exam nice enough, only in case you will be working yourself, right, during our course. So answering your question, this is not the task you will see this Saturday, no. But this is something I just encourage you to understand.
Okay, thank you.
Yeah, sure. Okay, as far as I get, we have to finalize our seminar. I will put this in Google Classroom this weekend. So not even this weekend, I will try to do it maybe today. Yeah, so look at that. And keep in mind, in Google Classroom, actually, you can put your comments after each task or, I don't know, something. So just remember, it's quite interactive. So you can comment there. Don't blame each other. Don't say bad words about yourself, your friends, for me. But just bear in mind that you can put a comment and I will try to answer once I see it.
And just one more question. Am I right that if we are going to be prepared for the exam, it will be enough to check all these presentations with the seminars, to check all these solutions, and it will be more or less enough?
It will be more or less enough, yes. You, of course, will have not only questions with numbers, but there will be some qualitative questions, right? So the questions which actually checks your understanding, and the questions which will check your understanding of the industry, so it's relative position in terms of size, right? So you should more or less understand the size of the industry, the players, the regions, a little bit, not something very to be specialized in, but still, if you don't get the flavor that the entry industry is small enough, it's roughly 1 trillion only, or not. I'm sorry, yeah, 1 trillion. So it will be minus for you, right? You should just go through the lectures, go through all seminars, and just read the books and do the tasks in Google Classroom. That will be enough.
Okay, thank you.
Yeah, but also I have to know that soon. So first of all, you have some tasks already in Google Classroom. Don't postpone doing them, because in the middle of the June, maybe at 11, just before the 12th, which is going to be a holiday, I should provide you with some group tasks. You will have to somehow put yourself together in groups and provide me the people in the group, and you will provide me with the case. It will be a case on the company, interesting enough, but to make this case, to I don't know, to make it easy for you, you have to understand all that we have already passed in our lectures and seminars. It will be quite interesting. At least it should be for most. Okay, I think we have to finalize. I will put that in Google Classroom again, and always I'm open for questions in email, but just take a chance and comment in Google Classroom.
I'm sorry, could I ask you one more question, please?
Yeah, of course.
Yes, could you please remind which chapters we need to read?
Chapters in the book, which
Yes.
is Venture and Finance Foundation. It's chapters 7, 8, 9, and 10.
Okay.
Yeah, but the most important for you in the nearest 2 weeks is 8 and 7, of course, but also in addition to that 8 and 9, because you already have some tasks on them. But you have this to read only these 4 chapters to understand most of the things we're talking about. Okay, thank you very much, dear students. It was a pleasure. I'm sorry, I have some in the chat.
Okay, sorry, I have also some questions. So, for example, where should we upload our assignments in Google Classroom? Should we send it to you by email or upload them to the Google Classroom?
You will have this in the task. As far as I remember, it is okay to upload them. So actually, you can upload your task in the Google Classroom. But there is no problem in that. Actually, you will provide me, and you will have the names of the people in your group. So it's a technical issue. Don't worry about that. In case Google Classroom will not work for some reasons, you will provide me an email, and that's okay.
Okay, and the second question is about the Saturday quiz. So, do we need to read some additional material besides the material that was covered in our seminars and lectures to be prepared for it?
No. But I have already mentioned what you have to read. You
Yeah.
have to read lectures. You have to read these first chapters, and of course, you have to go through some white papers which I provided you with in Google Classroom, in case you don't get it from the book or from the lecture. So use it as a separate additional task, either in case you have a high curiosity, or in case you didn't get it from lectures or the book. So play with that, be flexible, just get the understanding. That should be enough.
Okay, thank you.
Yeah, you're welcome. Okay, dear students, sorry, I have to run. I think you also have to run. And it was a pleasure. Thank you, and bye-bye. Take care.